On today's show, 3 questions. Number 1, can you expect rates to go down? Number 2, are you taking advantage of this market? And number 3, do big IPOs mean big returns?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Lauren.
And I'm Jake.
Yeah, you are. Guys, elephant in the room here. No Robbie.
Robbie.
There's
we
no
miss him
Robbie.
so.
And so Robbie's, for those of you that don't know, Robbie is enjoying a foodie trip. Literally, that's all it is. He's on a foodie trip for real, in China for I think 10 days. So cool. He's there.
Very fitting for him.
Very, very fitting for him. He's only missed in the 3 or plus years we've been doing 2 cents. He's only missed a couple of shows from traveling or whatever. But here's what I do know: every time he does, he listens, and he's told me he listens usually as he's going to bed. So we need to give Robbie a sweet dreams. Hope you sleep well.
Sweet dreams.
Good night.
Hope you're tucked
Nighty
in.
night.
Hope you're tucked in and belly's full, and we love you. So he really does. So he's listening to this giggling because he literally is laying in bed. So we love you, Robbie. Sleep well. Okay, let's jump in. I'm going to do my best. I'm batting leadoff, guys. I'm not used to this, and doing my best Robbie impersonation. We all know at the times I've done this. I'm literally the definition of a poor man's Robbie. So we're gonna do our best. But I've been hearing this a lot lately around rates, and people just, I think, assuming or expecting rates are coming down. Especially people I've talked to in discussions around buying homes. So whether it be clients or friends or just like people searching for homes, a lot of the sentiment is, oh, well, rates are coming down soon. I have a couple of friends who are in the real estate, who are real estate agents. And I'm like, oh, is this what you tell all your clients? Because it makes it easier. But anyways, there's a lot of assumption. I mean, are you guys hearing this around rates coming down and this assumption that they are?
Yeah, for the past few years. I think it's because of anchoring to those into 2021-ish, right, lows that we had where people could get, if we're talking about mortgage rates sometimes in the 2% or low 3%, and everyone was refinancing, and then we had that huge spike. I think it's that, right, then that rapid increase in rates to about where we stand now, around 6% or so. That rapid rise, I think, just made everyone think, well, this is going to be short term. We're going to get back down to some sort of normalization. I also think it's probably hopeful thinking for a lot of people who are really wanting to get into a home and really trying to lower their costs. And so they're thinking, I'll do this 6.5% if we just believe like we're going to get back down to a better place at some point.
Yeah. That's what I hear too. Lauren, are you hearing about the same thing?
Yeah, definitely. I feel like tell me if I'm wrong, but like on average, the rates have been way higher in the past. Like the lower rates are what's not normal.
Yeah.
And so people, I think, like, again, anchoring or like really anchoring to like 2% was like the thing for a while.
Yeah.
I actually myself was in mortgages for a little bit before I came to DA, fun fact. And I was pretty used to it where I thought that was the normal, being like, 2%, 3%. So these like 6% ones are still way less than what like it used to be or what the average was for like a while.
Yeah.
Right?
Yeah, it's very true. I believe, I don't have this in front of me, but and right now, obviously, we're focusing in on, I'm going to talk about a couple of different rates, but we're talking about mortgage rate specifically, which I think is the most pertinent rate to most
people care about the
people
most
out there,
Mm-hmm.
Dentists in particular. But yeah, you're right. I think the historical average, like historical 30
like
or 40 year
9% or
average.
something.
No, I think it's about where we are. I
That's
think
right.
it's
Oh,
like
is it?
high 5s, low 6s. So since we're on the topic, with mortgage rates specifically, they have now ticked up above 6.5%. They're back up to like 6.51 is the average right now. So not ideal. It's certainly, I don't know the data across the country, but I can tell you right now in Salt Lake specifically, things have slowed dramatically in regards to homes being on the market. I talked to, again, an agent friend of mine. He said right now the average time on market in Salt Lake, or in the East Side Salt Lake area, is, he said, somewhere between 30 and 60 days,
which is good.
Yeah, I
I
think
think overall, like, we could have a buyer's market, right? Well, this is interesting if it even is a buyer's
is
market
it?
in real
Yeah.
estate,
Yeah.
because all of these sellers are pretty, I don't know what they're like stuck on their price. They
Yeah.
don't want to accept a lower price. That's probably why these houses are staying on market longer.
Yep.
So, like we mentioned, average historic rates, Lauren, that you mentioned there. Yeah, we're probably around long-term averages.
Pretty
The one
dang
thing that's
close.
different, though, about today is housing prices are not near,
No.
historic housing prices are way higher. So if you do higher home prices with average rates, you're just
rates,
getting
yeah.
higher costs, right?
Mhm.
For
Yeah.
homes.
Well, and that's what's interesting too, Jake. I think, and Lauren, kind of like what you're saying, where people are anchored to these old, we had a decade long, basically, worth of really low rates. People are anchored to that. I've also realized and noticed, just in like anecdotal, just looking around at the housing market, at least locally, that sellers are still anchored to old
Yeah.
prices,
Yeah.
thinking that you can get. So I think that's kind of what's happening a little bit of why things have slowed, is because rates are up double what they were. And it happened quickly, to your point, Jake.
Yeah.
And because things increase so much with prices, people who are selling their home think, well, I can sell this for 1.2. Like,
Yeah.
it did 2 years ago, but then buyers are like, whoa, no, because the payment on that is now double what it would have been 2 years ago.
Or
So
sellers are thinking, if I'm going to give up my 3% mortgage rate, I want to get this
Yep.
high price for my house. I don't want to give up my mortgage rate and have a bit of a deflated price for my home. That feels worse.
Totally. Yeah, I think there's a little bit of delusion of what
Delulu.
prices are now. And I think it's, to your point, Jake, I think it's good overall. I think it's kind of okay. We have to go through this phase of normalization and maybe re-anchoring. That just takes time. So, which is interesting, because now if you think about it, the longer this goes above 6.5, somewhere in that range, just imagine what's going to happen to the market if it drops even 1%. Just imagine if we got into the 5.5% range,
Which is
somewhere in that.
Instant frenzy.
It's going to be a frenzy, which
Instant
is
frenzy.
crazy, because again, it's just this like
It drives prices
this
back up.
example of anchoring. When you go from 3 to 5.5 versus from 6.5 to 5.5, completely different results and response. So it'll be interesting. The other one I wanted to talk about that, again, we're hearing a lot of people probably being a bit confused and again, assuming that rates are going to come down. Talking specifically about the rate that the Fed controls, the Fed funds rate. So I guess maybe just back up a little bit. When we say rates, there's a lot of different rates we can talk about. Mortgage rates, which are often, they are tied to the 10-year treasury. That's really what they're linked to. Is different than the Fed funds rate, where the Fed controls what's called the overnight rate, or the rate that banks lend money to each other. That's really when we talk about the Fed and the rates, that's what we're talking about, not mortgage rates. So there's not a direct link between those two things. We've actually kind of flipped, guys, from when will the Fed cut to could the Fed actually hike rates, which is kind of interesting. So I have some data here showing kind of what the market is currently pricing in. So the next Fed meeting is with the new Fed chair, our boy Kevin, who Robbie's still, Robbie's still kind of in the honeymoon phase.
He's filling him out a little bit.
He's filling him out, kind of figuring things out a little bit. He's still, I think, reeling a little bit from Jay Powell being gone. But the next Fed meeting is June 16th, 17th. Here's the current odds, the market implied probability. Right now, it's at 98% probability that they're going to hold rates right now between the 3.5 to 3.75, a 2% and change that they're going to cut, and then a hike is 0 as of now. However, if we look at longer term, so we go out to the Fed meeting of December 2026, there's meaningful higher chances of rates actually being hiked. So right now, about a 32% probability based on the market that we're going to hold even through December. There is a 43%. The highest probability right now is 43% that they're going to hike in December. And then 21% that they'll actually, here we go. There's actually a 63% chance right now, or no, even more, 67% chance that they will raise rates. The question is right now, the leading indicator is 43% that it's only going to be 25 basis points. then 21% chance it'll actually be 50 basis points, and then a minimal chance it's actually more. So right now, by December 2026, there's a 68% chance right now that we're actually going to hike rates as opposed to lower them. Does that shock you guys? What are your guys' thoughts on that?
I don't know. I don't know if it shocks me.
I'm in for it. I've been saying this for a while now. I'm fine with higher rates. I am okay with less money flowing into the economy. I'm maybe one of the only people who thinks the economy is in a pretty good spot right now. I think things are pretty great. We don't need to get into all the details of unemployment or different things there. I mean, housing's the one that you can maybe have an issue with, but I think things are moving along pretty smoothly now. I think the one huge concern is inflation has ticked
Yep.
up a little bit again recently,
This is exactly why rates right now we're looking like they're going to get
yes, if you
hiked.
want to increase rates a little bit, that's an attempt to cool off some of this inflation, which I still think is people's biggest worry and biggest stress. And so I am okay trying to lower inflation with some higher rates and not pumping money into the economy.
Yeah.
I'm okay with it. I think it's good.
Well, yeah, and as Robbie mentioned this last week, you can't cut rates right now.
Yeah.
Inflation is actually ticking up.
Yes.
So the last thing we need to do is cut
Just
rates.
cut them.
That, people, do you remember 2022 people? If you're asking for rates to be cut,
yeah,
you can't, they just can't do that right now. So, but to your point, Jake, that's exactly why it is indicating that we have nearly a 70% chance of a rate hike by the end of the year because inflation is increasing. I think I have some data here on so April CPI rose 3.8% year over year. That's up from 3.3 in March. Core CPI ticked up to 2.8%.
Yeah.
Energies jumped 18% year over year. A lot of this is just tied to what's happening in Iran. But again, we need to pump the brakes on any idea of a rate cut because until we see different numbers on the inflation side.
Yeah, I'm fine with a bit of a cooling in the economy, right? Everything seems to be firing at all cylinders, stock market, earnings, inflation's going up, spending, it's all, things keep moving up and to the right on every graph. I'm okay if we introduce, we talk about this all the time. I would never advocate for a recession. Those are generally bad for actual human beings and people lose jobs and there's bad financial situations, but they are part of the economy. And we do the economy works where you kind of have boom periods and we got to take a breath a little bit to get back to another boom period. We're going to have some sort of drawback at some point in the future. We don't know when, but they're features of the market, not bugs. And I don't advocate for them. Recessions are tough for a lot of people. But I'm okay with cooling off a little bit economically.
Well, to your point, Jake, nothing's cooling off right now. I mean, labor market's strong, added 115,000 jobs in April. Unemployment rate is at 4.3%.
Yeah.
So still positive on the job market front. Things have slowed slightly as far as additional jobs but right now the labor market is still strong, which is everything hinges on the labor market, basically. Yeah. People have jobs and feel confident they're going to spend money. 70% of our GDP is based on spending. So it all hinges on that. So I know you're going to talk about the market, but to your point, outside of real estate, outside of homes,
your new home buyers
and mortgage rates and first time home buyers, we understand it's brutal. But I think people link that to, if you can't buy a home as a first time home buyer, that means the economy is terrible.
Poor. Yeah.
It just shows how much of that American dream, proverbial American dream,
is to buy a house.
Yeah, is embedded in our psyche of home ownership. But you're right. The actual figures show overall the market is,
and maybe mortgage
really
rates being stubbornly high and even trickling up a little bit can help with that. Again, if we can get houses on the market for a longer time, maybe homeowners will finally give in and lower their prices and make it a little bit easier for buyers to get in.
Yeah.
Yeah. I mean, the cynical way is if you are a first time home buyer wanting to buy a home, you could afford a bit of a pullback here, right? You kind of might be rooting for one secretly in your heart, right?
Oh, sure.
House prices and things going down or things economically not working out. So it gives you an opportunity to get in.
What's actually interesting, we should dig into this more for another episode, but another, maybe next week or something. Does it seem kind of intuitive that possibly what's happening in real estate, and we have a huge shortage in single family home ownership or homes, rates are high, it's expensive for a first time home buyer, that in some ways that actually helps the economy in the sense of people have maybe given up for a while and you know what, I'm not going to buy a home So then what else do? They vacation more. They buy
They spend.
they buy a nicer car. They spend more. Like those dollars are going to be reallocated somewhere. We think they probably should be saved.
There's
But
data that shows that people have been actually increasing contributions to investment accounts because they've not been able to get into a home.
oh, interesting. Okay,
Which you could argue is a better long-term financial move for a lot of people.
for sure.
And yes, there's a lot. I notice anecdotally, a lot of people are like, I've been saving up for a house. It doesn't look like it's happening for me. I'm going to take that trip to Fiji.
Yeah,
Or I'm going to take this trip. I'm going to go to that concert and buy more stuff. And it's like, there's also this like financial nihilism among Gen Z, which is causing them to spend a lot of money. But yet that spending on things other than housing is propelling our economy
yeah,
forward.
that's really
funnily
interesting.
enough.
Yeah, I
But
can.
you're saying on average, people are like saving more than they're spending it. Like if
Yeah,
they're not buying a house, they're like, oh, I'll invest it.
Yes, and their
I'm
savings
so
rates have gone
surprised
up
by
into
that.
their investment accounts.
I don't know why,
makes
but I'm way
sense.
surprised by that.
Yeah, it makes sense.
Because
Like,
they don't
Maybe
have
the
a
people-
mortgage. It's also if you're paying rent right now, rents across the country are less than mortgage payments.
Yeah,
Like
they're
the divide has been as big as it has been in a while. And so even by not being in a house, you typically have a lower rent payment than you would having a home. And so
Right.
there's more discretionary money that you can save and put other places is helping you financially.
Yeah.
Rather than just dumping all our extra dollars, I have a mortgage that's 40% of my income. That's all my
Yeah.
extra dollars are going to my home. There's more money to spend or save and do other things.
Yeah, again, it makes sense. So to put a bow on this rates, and we'll jump to the next. The other, again, when we talk about rates, there's a lot of different things. The other ones that are really pertinent to dentists are what's happening like on the business side or student loans. But on the business side, I don't have it right here in front of me. I don't know what you guys are seeing, but on practice loans, they've actually held really steady and relatively low.
5.5%.
Yeah, like 5.5. I've seen low fives.
Low fives
They-
is great.
They
Yeah.
dipped into the high fours for a period of time there. They're probably up a little bit, but somewhere solidly in the fives. So still from a business investment on the dental front, there's not a ton of concern there. They're
Yeah.
still actually really quite reasonable on the rate side for practice loans.
Yes.
Okay. Anything else you guys want to add on the rate front or the economy? Okay, Robbie, we hope he did you proud. He's probably snoring by now. Okay.
We lulled him to sleep so nicely.
Yeah, we lulled him to sleep. Hopefully no one else is. Number 2, Jake, are we taking advantage of this market?
If you guys did not know, the U.S. stock market's on a bit of a tear over the past couple of years.
A little bit.
23. So the annual return from January to December was 26% return in the U.S. stock market. 2024 saw 25% return. 2024 was 25%, and then 2025 was a tick under 18% return. On average, the stock market goes up about 3 out of every 4 years, right? If we average out over the past 100 years, that's kind of your odds, 75% chance of the market's going up. I had a lot of discussions with people of, hey, 23, 24, 25 were really awesome. Are we due for our down year in 2026? Well, we're up over 9%, and we're not even halfway through the year so far in the U.S. stock market, which is pretty awesome. Like, we're on pace for another double-digit increase. Like, we could even creep up to like another 20% year here.
And Jake, I don't know if you have, I don't know if you did this before, emerging market data or
I do have it. Yes.
Okay.
And so this is not just the U.S. stock market juice. Those are U.S. stock market numbers. It is happening across the board. So let's start with emerging markets, right, which are kind of smaller, underdeveloped foreign countries. 2023 was a 10% return. 2024 was an 8% return. 2025 was 35% in 2025 emerging markets. Developed markets, on kind of the flip side, the other international stocks, was 24% in 2023, 19% in 2024, and 21% in 2025.
Wow.
Up across the board. Even if you look at things like gold, silver, Bitcoin, really whatever you want, like kind of every segment of the market has been crushing the past handful of years. Like everywhere you look, market's going up. So much so that's like, again, just using it's easier data just on like the S&P 500 side. If you had invested $10,000 in January of 2023 till now, you would have $18,500. So that's no additional contribution. So that's almost you've doubled your money, nearly doubled your money in about 3 years.
It's pretty impressive,
in the market here. Just pretty wild. A doubling in about 3 years. I wanted to bring this up. Let me see. Let me share my screen here. I have a graph for the people who are watching this on YouTube.
YouTube, like and subscribe.
Like and subscribe. I am sharing screen. Here we go. Okay. So I did a graph because I think this highlights an important market principle that I wanted to go over here, which is we talk about long-term stock market returns. If you look at the S&P 500 in U.S. stock market going back to 1970, the long-term average annual returns about 11%. It's kind of where it's sitting. However, how the stock market works is there are very few years when you're getting an actual 11% return.
If
Right?
ever.
If ever. Right. So I have this graph here. You can show this. This is every year return going from 1970 to 2025. And you can see 2016, we had an 11.96% return. Is probably the closest that you're getting to that 11% long-term average.
Yeah, 2024, we had just under 11.
2024 is 25%.
Oh, sorry, 2004.
2004, yes, was just under 11. You're getting 1993, 10%, right?
Yeah.
Very few times. If you look at the rest, though, the returns are pretty variable here.
Yeah,
Right?
all over the place.
All over the place. And so what I wanted to bring up is there will be a future where these past couple of years have been awesome. There's going to be a couple of years where they're not so awesome, right? We're going to have a negative 11% year, or in 2022 we had negative 18 or a negative 4, or even on the positive side we might have a nothing burger, a 1994 where there's a 1.32% return, right? Kind of where the market was flat. The point is 11% compounded return annually makes pretty awesome numbers over time. If you can get 11% per year, your wealth is going to compound at an amazing rate. However, in order to get that 11% return, you need to be invested for these past couple of years. You really do, because we're going to have down ones. And so over the past couple of years, there's probably been a lot of political things, war in Iran and inflation and the advent of AI and all this different stuff, and a lot of worries in the world. Yet the market still chugged along. I don't know if anyone would look at after 2022, be like, man, we're going to go on a tear here in the market over the next couple of years, but we did, and that's what's happened. And so I just wanted to bring up. I'll stop talking here and let you guys jump in. But my main point is market returns are lumpy, and because they're lumpy, you need to make sure that we're taking advantage of these 20% awesome years that we've had the past few. Any thoughts from you guys?
I feel like this graph is so important. I feel like whenever I talk to my clients, especially ones that are risk adverse, that are my parents went through the housing crisis or things that are really uncomfortable for them, and they really focus on those red years. It really is so nice to show this where it's are there some reds? I feel like we can pretty much say there's going to be a red at some point, but it's to focus on the long-term growth. So I love showing graphs like this. I think it's so helpful to solidify the long-term strategy and not just short-term gains today and right now.
Yeah, it's so true. I just look at this and I'm like, building wealth is so simple.
It's not very sexy at all. That's
it honestly is so simple, and it also is so difficult because all of it. I mean, it's this age-old thing we've talked about so many times, but it's you've got to defeat the final boss, which is always yourself. It's I always think about, again, when you look at that graph and you talk to people, it never feels like a good time to invest ever, because either we are currently in the midst of a back-to-back to seemingly what seems like a 4-time champion 20% plus return in markets. By the way, Jake, I don't think you mentioned what's happening in emerging and developed currently in 2026, but I believe as of last week, Robbie hit this. I think emerging's up year to date 23%.
Yeah, on a roll.
Or something like that.
Mm-hmm.
So right now, it's really easy to trick yourself and say, well, it's coming down. It's not a great time to invest. I'm going to wait till it comes down. And then on the flip side, when we have a string of negative markets, like you were showing on that graph, the
biggest string recently is 2000 to 2002, which is kind of the tech bubble, right? You had 3 years of nearly double digit negative. Yep.
So really easy in those years to be like, nope, it's not good. It's all red. I'm seeing red on the screen. Why would I buy? I'm going to wait till it goes back up. So it's really easy to trick yourself, and not to mention all the scary things in the news. If I hear one more time that this is unprecedented, whatever is going on, I'm like, okay, whatever. No, it's not. So it's so easy to trick ourselves into thinking now's not a good time to invest. But the answer is actually quite the opposite. It's always a good time to invest. So just highlighting it's so simple, but also so freaking hard.
Yeah. And we just always talk about riding through the bad times a lot. It's there's going to be down markets, ride through those. I kind of wanted to take the inverse of that is make sure you're riding these highs that we're having too, right? Like you
Yep.
need to take like because like you in order to get that 11% return, you need to have like your doubling that we've had of your
Yeah.
portfolio over the past 3 years is how these things average out. And so I think it's very easy, through these markets to be like, oh, the market's going up. I'll get back in another point. Like you need to be in it. Like this is the time to make hay, to kind of be
Yep.
taking advantage.
Okay.
Yeah.
So which is really cool. Again, if you're listening and you've been invested the past couple of years, I hope you're seeing your time and patience rewarded a little bit
Yeah.
here,
Fruits
seeing
of
your
your labor.
portfolio like the past
We've
3
seen it.
years.
We're
Yes,
seeing it
our
with our
clients, like
clients.
your portfolio is just taking huge leaps and bounds, which
Yeah,
it's
these
always
end of
nice
year
to
calls have
highlight
been
the
fun.
wins. Yeah,
Yes.
highlight the wins of like this is growing, it's working for
It's
you.
really fun to review portfolios right
Yes,
now.
right now.
Yeah.
We did it.
I
at
also warn them. I say, this is a really good year. I'm excited about it. But remember, it's not always
Oh,
going to
are
be
you
like
kidding me?
this.
I show
Don't hate
'em-
me when it doesn't look like this.
I try to show clients, 3-year, 1 year, to rolling 12, kind of show them all. The rolling 3 right now is incredible. To your point, Jake, we're seeing literally multi 6 to 7 figure increases over the last 3 years for a lot of our clients. And I always emphasize to them, our main job here is to help you capture these returns
Mhm.
and set proper expectations for you that like this
For
is
the
not
future.
always the case. To your point, Jake, there's gonna be times that we're having this conversation and we're showing you negative figures.
This is often
Exactly.
how it works though, where it's like you'll have 5 years of like not much has happened to my portfolio, and then all of a sudden you'll have 3 years like the one we've had, and it's like, wow, a ton happened. That's kind of how it works, which is kind of illustrative of the point. It's lumpy and messy. It's not like the clean compound calculators that you see when you type in your stuff. It's like it'll be, man, I haven't seen much for a couple of years, and then all of a sudden, whoa, what happened over the past few?
Yeah,
Is
it's
pretty common.
it's so true.
Mhm.
And there's actually good in both, right? So meaning if really and when we have negative markets and maybe a negative string of markets, if you are a younger accumulator dentist, which a lot of our listeners are, a majority of our listeners are in their mid-career accumulation phase, both things are good. Meaning, Jake, what you're saying now is this string of 3 years of incredible market is helping you double your portfolio, which is amazing. And then also you build a lot of wealth when markets have that string of negative markets and you're able to accumulate more shares to then have another doubling down the road or even more so because you're able to. So again, there's positives in both.
Yeah. It's like those we talked about, those homeowners, first-time home buyers who may be secretly wishing for a bit of a down market so they can buy a house. You could maybe secretly be wishing for a bit of a recession in the stock market to buy stocks at cheaper prices for you in the long run.
But that feels weird to say.
Mhm.
But it is fun when I have clients who will be like, man, when are we going to see a down market? Like, it's fun to see that. I'm like, oh,
Yeah.
you're actually waiting for that, which is actually kind of cool to see, like the mindset shift. So cool. Anything else, guys, in the market? Lauren, anything from you? Okay.
No.
We're going to jump to the final segment here. Do big IPOs lead to big returns? Because there's something big coming up that people are talking about.
Yeah, I had a call the other day and they were talking about how they have an IPO, and actually they said they had a couple, but I feel like they were being very specific, and they were like, we know we are guaranteed, they use the word guaranteed, that it's going to be good. And I can only imagine I can only imagine that they may or may not be talking about the big one that's coming up. Like maybe they're talking about SpaceX, the big thing that I feel like is coming, where they're like, we've got something that's like in our pocket and it's going to be big.
This is it. Yeah.
And I kind of wonder, I don't know if this is what they're thinking. I don't even know if people can even do it right now. I don't think they can yet, but I wonder if that's what they're like. We have put aside a chunk of money. And I just thought it was interesting that they were like, we are guaranteed these IPOs that we just bought in these new startup companies are going to be awesome. Like these new things.
So they put money in private companies that are going
They
public.
put money. They also put money. Yeah.
Okay.
They have a couple that they said that they were guaranteed that it's going to be big. But I mostly wanted to talk about like the big one, the big IPOs that come out. The amount of people, I don't know if you guys have gotten this too, but I feel like it is everywhere. Like I looked at some articles today and was just kind of scrolling through Apple News and I was like, SpaceX. It was like everywhere.
Yep.
So I don't know if you guys are getting that too.
Yeah, Jake said was just reading about it this morning.
I was reading about it this morning. It's interesting.
SpaceX
Yeah,
is
I
a
think
big one.
SpaceX is the one coming out. They've like filed stuff, right, to become a
Mhm.
public company. I think they've been a
Yeah, I
private
think
company for like 25 years.
Yeah.
Really long time.
I think it's happening. I don't know. Have they announced a date yet? I know they've
No.
filed.
I don't
They've
think they
officially
have.
filed.
They've
But
filed, which
they
is
have like some anticipation of what they think the numbers are going to be.
which this would be, again, we'll get into the numbers. Like this would be the biggest IPO as initial public offering is like the word. This is when a company goes from a private company, right, to a public company, allows for public investors. To you're listed on a stock market exchange. SpaceX going public, I think, would be the largest valuation of any company ever.
Targeted for June 18th, by the way.
Yeah,
Let's go. You guys want to get in on that or
next
what?
few weeks. Yeah.
Maybe.
Well, I was like looking at some of the information. So the last like biggest one was Alibaba, and the capital raised was 21.8 billion, and SpaceX is anticipated to be 3 times the size of Alibaba. So it's supposed to be just huge and
like
Trying to get
massive.
$1 trillion. They're trying to get $1 trillion.
1.75 trillion.
That's crazy. That is huge.
Yeah.
And my question is like, if everyone already knows it's coming and everybody's all hyped and excited about it, I'm like, is there really any money to be made from that?
Yeah,
And
well,
I wonder.
we can break this down a little bit. So usually when your company goes public, that is an awesome, incredible, like that is the end goal for
Opportunity.
most of the people who work at that company, right? And had the private shares. All of the people who got stock and private shares before, once you go public, you're usually getting a pretty big multiple on your earnings. That's usually like when you're cashing out the founders, early employees, and they are making a ton of money,
A ton.
right? When that
Elon
happens.
becomes a trillionaire after this, maybe? Who knows?
Yeah, no, like you make a ton. So there's a difference between the people, private investors before it went public
Versus, like,
and
employees.
the average Joe, like I'm going to buy this once it becomes public on the stock market exchange. Those are two different things, I think, to delineate there.
Yeah. One other thing I noticed here, they have a historic amount of allocation to retail. So they're saying 30% of the allocation will go to retail, meaning you can buy it at Schwab, Fidelity, Robinhood. So they've never had it that high.
Yeah.
So, but good luck getting in line for that one.
Well, yeah,
So-
I just have had so many friends message me and be like, you getting in on this? You getting in on this? So hyped, so excited as they're driving their Teslas, I'm sure. But
yeah.
I was like, okay, well, how often does it happen that these like go to the moon, and what are actual historic returns of these and how do they do? And interesting enough, historically they underperform, which I think is kind of funny.
Yeah.
But it says 2/3 of IPOs underperform the market after 3 years. So I have a couple of averages. So first year average, I think this is like the big hype after 1 year because everyone's coming in, right? So average 1 year, it says 9% return of the top, like I think it was like the top 10. But to be honest, like a lot of them have like been taken off and delisted
After the fact.
after the fact.
Yeah.
Yeah. So the average 3-year return is negative 3.4%. So maybe after a couple of years, people are like, ugh.
Yeah.
Which I actually think is interesting because I think a lot of the problem here, and you guys maybe can speak to it, but people have such expectations where SpaceX is supposed to be so amazing, so awesome, things are going to be so great. And it's almost like, do our expectations create this demand for them to obviously exceed expectations?
Yeah.
So maybe they still do amazing. Maybe they still do all the things they said they were going to do. But as investors and people who are invested in them, they're like, but it's still not good enough.
Yeah.
So then after 3 years, they're like, I'm going to kick it.
Well, and I think part of that too, Lauren, is it's a great point. I mean, IPOs are the quintessential example of hype. Like it's just that people only buy IPOs based on hype.
It's a new stock, right? It's like
Yeah.
it's like a new clothing
toy.
line coming out. Where it's like
Yeah.
people who are into the stock market, we have these like certain amount of stocks that we can play around with. It's like all of a sudden we're getting some new ones, right? Some
Yeah.
like fresh, shiny toys that we can get in on the ground level. And so that's just naturally exciting for people, possibility, potential of what it could be.
Yeah, I told you guys before we got on, I worked at Fidelity as a trader when Facebook IPO'd, and it was insane. Like,
Imagine.
talk
How many
about
people called
hype.
in?
It was insane. Every second or third call we had at the call center as traders was like, how do I get in on Facebook? What do I do? And the allocation for Facebook to retail was limited. And so I was like, there's nothing you can do. I don't know what to tell you. It was insane how many people wanted to get in on that. Usually, and I don't have the data, but it was a huge pop initially based on hype, and then a massive drop. Now, long term, as things, to your point, Lauren, hype kind of dies down, and then it becomes more about like the fundamentals of the business. If the business can do well, it can have incredible return. Facebook has crushed
Yep.
over the long
Yeah,
term.
since the return, like the IPO, the return has been 1,498% for Facebook
Yeah.
specifically since 2012. So
Yeah.
sometimes, yeah, they can, and again, we're holding it the entire time since the IPO.
If your company's Facebook, yeah, you're going to have
You
a good
was
return.
What'd you say, Jake?
Like if your company's Facebook, yes, you're going to have good return. If your company's one of the most important companies to ever exist in American history,
Yeah.
you're going to be okay.
Yeah.
And congratulations.
Yes.
Yeah.
For
But some
sure.
of them have done really, really poorly. Vian is one of these since 2021 that's done poorly. Since its IPO in 2021 of November of 2021, it is down 82%.
Wow.
So this part where people are like guaranteed, Rivian is supposed to be a good company, but it's like, did we overhype it and get really excited?
Yeah.
I don't know.
Well, Jake, I know you had data you were looking at of like this wide dispersion of data around the ones that do really well, absolutely crush.
Yep.
But a good chunk of them don't do well. Again, it's the same. It's day trading. It's hype. It's trying to find the next unicorn. And go ahead, Jake.
Yeah, on average, it shows about 2/3 of IPOs do underperform the market over a 3-year period, which I think, again, they typically follow that pattern of shooting up early on and then they have some regression back to a middle. That's a lot due to the people who already own the stock are trying to pump it up, and these bankers and institutions are trying to get the price as high as they can because they do want to sell right away. This is not a long-term hold for them. They're getting in at private shares, selling at public shares, taking that and going to their third home and enjoying their day at the pool. But yeah, so most IPOs do underperform after that initial, mainly because they're getting priced really high at the outset because of the high. Like it's just naturally the hype, just goes away with it. But yeah, there are obviously with any type of stock, there's a few that will outperform and give some pretty awesome returns. It's just, it's like Matt said, it's day trading. It's trying to pick the right stock. It's really hard to do. 64% underperform the market over 3 years by at least 10%, which is a pretty big margin, like a pretty big gap, not just slight underperformance by quite a bit. Is SpaceX going to be awesome? Who knows? I was reading a thing this morning that they lose $5 billion a year. It's like they're on their income statement. Which again is not with a lot of these companies before they go public and things like that's how businesses run these days. They're just a lot of investment and they're investing back in infrastructure. And so maybe not super crazy, but losing $5 billion a year with the valuation of like $1.5 trillion or whatever that they're going for here would make it like the highest price to earnings stock ever. It's like double anything that's currently in the market. I think like Palantir is the highest like price to earnings stock like 60 times currently in the stock market. And this would be like 120 times.
Which is wild. And so backing up,
insane.
all that means when we say PE ratio, price to earnings, saying the actual price on the market to the actual earnings of the fundamental business, the revenue of the business. Yep. So if you're losing $5.5 billion, $5 billion a year, like
price to profit is nothing. There's no denominator. They're not making a profit. Nothing. But from revenue, even just revenue alone, you're paying like 120 times. Every dollar that SpaceX brings in, you're paying like $120 for every dollar they're
$120. That's 120x every dollar.
Which again, the highest in the stock market right now is like 60. I think it's Palantir is like 60 times.
That's crazy. Yeah.
It's hyped. Definitely hyped.
Yeah. It's interesting. And I always think about this kind of stuff. I mean, again, we say this, people who get tired of it, I'm sorry if you do, but you're still going to get exposure to these things if you have a systematic, globally diversified portfolio. You don't have to pick the winners. You don't have to, and I know it's hype, it's exciting, it's fun. You read the articles, you talk to your friends, are you getting in on this? It's kind of like this fun thing. Investing shouldn't be fun. It shouldn't be. It shouldn't be exciting. Find your fun elsewhere,
Go to Disney.
The odds are not in your favor to think you're going to build your wealth off IPOs.
Well, what's the percentage of that, right? Like, Jake, I feel like sometimes you bring this up where like the majority of wealth is built from sticking and staying to like a nice diversified portfolio. Isn't it like 90 something percent?
Yeah. Like there's a study done by Henrik Bessember, just like a market studies guy did a couple of years ago, where he showed that of all the market returns over the past 100 years, they're all attributed to 4% of the companies, 4% of stocks. And it created all the wealth essentially in the stock market. So essentially saying, and there's like half of all stocks underperform cash and treasuries. And so like you have essentially like a 90, like there's only a 4% chance of picking one of these awesome stocks that are going to make you before they go awesome. Kind of hard to like bet your retirement
kind of hard to
4%.
hit that.
Yeah.
But SpaceX is going for it. It's guaranteed, they say.
I will say this. There will be a lot of people who make a lot of money on SpaceX.
Totally.
And most of them are already invested in it or working.
But the odds of it being you are pretty low.
Pretty low. Yeah, pretty low. Okay, that's great, Lauren. Anything else you want to add to that, or Jake? Anything else? Okay.
No.
We do want to hit so Summit coming up. We have a couple of weeks left, which is crazy to say. But we do have space if you're still interested in coming. If you're on the fence, I actually talked to Dennis last week on the phone, not a client of ours, and he's like, I think I'm going to come. So he's actually signing up this week. I was like, you can. The main hotel, when you go, if you go to register, the main hotel where the event is booked. Our room block is booked. However, there's a hotel right next door, like literally sharing parking lots, that does have space, which is the Homestead. So if you're interested, don't be deterred. If you're like, oh, I can't find a room, you definitely can. You'll just have to stay at the other hotel. If you are interested, if you're on the fence, I think the answer is just come. You should.
Yeah,
I think just come.
Clearly the party is popping. We're booking out hotels, y'all.
Yeah,
come
we're
on.
booking out hotels. So DennisMoneySummit.com if you need more information. We'd love to see you there. Come hang out with the team. And then we have our second cohort of Launchpad. I should have done this at the beginning. Our second cohort of Launchpad. We just wrapped up our first class. We have our second class starting in September. We've made some pretty major, really major improvements to the class based on feedback and just our experience. So it's going to be even better the second go around. If you want more information on that and get early bird pricing, go to DennisMoneyLaunchpad.com. Love to have you at that. So for now, Jake, Lauren, thanks for being here and sharing your wisdom. Everyone, thanks for listening. Nighty night, Robbie. That was our 2 cents. Till next time. Bye-bye.